Hello and welcome back to another stock analysis on Stock Market Palantir. Make sure to subscribe and let us know your thoughts in the comments. Now, let's hear from our analysts.
The situation with Mawson Infrastructure Group, MIGI, is, well, it's not just distressed. I think it's fundamentally broken on a mathematical level. What we're seeing is a rare, almost engineered financial event that's driven by pure market mechanics, and it sort of defies any kind of conventional analysis. That 1-for-20 reverse stock split they did back in November 2025 just completely reset the board. It slashed the share count down to, what, just 1.14 million shares.
It did create scarcity, absolutely. But you have to admit, it also created a huge amount of instability. We saw the result of that immediately, right? The volatility went through the roof, and we saw a massive surge in the cost to borrow, the CTB. That rate has been swinging wildly. Recently, it even spiked past 200%.
And that's the core of the debate right there. I mean, we are talking about a stock where the short interest is over 31% of that unbelievably thin float. That's about 350,000 shares short. This is not some small argument about valuation. This is a high-stakes forced trade scenario. So the real question is this: does this technical setup, what I'm calling the squeeze thesis, create a real asymmetric buying opportunity? Or are the catastrophic fundamentals, the solvency and dilution thesis, just an unavoidable ceiling that means this thing is doomed to collapse?
I'm firmly in the latter camp. My position is that the fundamentals are so critically weak and the balance sheet is so tilted towards, frankly, imminent failure that no technical weirdness, no matter how extreme it gets, can save the equity. You have to look past the short-term noise and just accept that this company is struggling with operational obsolescence and a really acute solvency risk.
I get why you're focused on the solvency risk. I do. But let me offer a different perspective on just the mechanics of it. A float of just over 1 million shares for something on the NASDAQ is, it's almost unheard of. This scarcity, which was engineered by that reverse split, has created what I'd call a powder keg dynamic. The market is not acting rationally here. It's acting on the fear of being forced to close a position.
But if we ignore rationality, we're ignoring reality. And I come at this a different way. The reality is on the balance sheet. This company is, for all intents and purposes, a zombie miner. The insolvency risk is palpable, and the one data point that just screams distress is the current ratio. It's sitting at a devastating 0.35.
Okay, so let's break that down for a second. For anyone who's less familiar, when you say the current ratio is 0.35, it means for every single dollar of short-term liabilities the company owes, it only has 35 cents in liquid short-term assets to pay it. That is a critical distress signal. It shows a profound, immediate inability to manage its working capital.
Precisely. And the cash position is just as scary. You've got $2.28 million in cash against $27.3 million in total debt. That gap defines the ultimate ceiling. The high CTB you mentioned, that 137 to 201% range, yes, it means time is against the shorts. It traps them in a negative carry trade. But the second any price appreciation happens from that squeeze, management has an instant, unavoidable tool to just absorb it all.
You're talking about the at-the-market equity offerings, the ATM.
Exactly. They have an S3 shelf registration ready to go. So that lets them raise the cash they desperately need to cover their huge working capital deficits. The instant the stock pops, they sell new shares directly into that buying, which neutralizes the squeeze and, guarantees aggressive ongoing dilution. That's why I think the whole squeeze thesis is flawed. Any rally is just a selling opportunity for the company itself.
I acknowledge the dilution risk, but you're framing it like it's an immediate, complete wall. I would frame it more as a question of timing and momentum. The squeeze mechanics are immediate. They're forced. That 31% short interest on a microfloat, plus those triple-digit borrow fees, it creates this enormous forced buying pressure that has to resolve itself before management can leisurely execute an ATM offering to put a lid on the stock.
But the mechanism isn't leisurely. That's the whole point of an ATM offering, to be clear. An at-the-market program lets a company sell shares right into the open market, at whatever the prevailing market price is in real time. There's no waiting period, no roadshow. The company's agent can inject shares instantly, soaking up the buy side of the order book just as fast as the shorts are trying to buy to cover.
You're right, it is fast, but momentum is sticky. If the price goes vertical, say 100% in one day, which is absolutely possible with a float this thin and shorts this high, management physically can't dilute fast enough to stop that initial surge. The technical reality of forced buybacks and just the difficulty of even finding those shares to buy, it will temporarily overshadow the fundamental reality. The short sellers are hemorrhaging cash. I mean, 200% interest a year is like paying back the entire short position value every 6 months just in fees. That pressure builds a momentum that you can't just dilute away in an instant.
But that momentum is guaranteed to slow down the second those new shares hit. And every dollar they raise prevents default, sure, but it's paid for by destroying equity value. They aren't raising capital for growth here, they're raising it for survival. Let's pivot to the operations side, because if this company was actually doing well, maybe the dilution wouldn't sting so much. But I stand by it. They're a zombie miner, just struggling with outdated tech.
I have to firmly dispute that zombie miner label, or at least how it applies to MIGI right now. Yes, the Bitcoin mining part is struggling, clearly, but the company has successfully built out a separate and profitable business segment, energy management revenue. This isn't just some side hustle, it's providing critical survival capital.
The energy arbitrage? What are you referring to specifically?
Yes. In October 2025, that energy management revenue was up a staggering 191% year over year. It hit $1.6 million. This changes what the company is. They're effectively acting as a virtual power plant arbitrager, especially in the PJM market, the big grid operator in the eastern US. They get paid to cut their power use or sell it back to the grid. That gives them a revenue stream that is completely decoupled from Bitcoin's price. That arbitrage is the life raft keeping them from sinking.
But relying on seasonal energy credits is a symptom of failure, not a growth engine. Let's look at the actual mining business. Their operational hash rate is stuck at around 5 exahashes per second. For context, the industry leaders are pushing 30, 40, 50 EHs. They just are not competitive.
That's a fair point on the scale, yes.
And look at their self-mining revenue. In October 2025, it was only $100,000. That's a catastrophic 55% drop year over year. They're shutting down their old inefficient machines. These are probably fleets with efficiency worse than 25 joules per terahash. Post-halving, it's just not profitable to run that gear. They're arbitraging power because they have to, because their core business can't make enough Bitcoin to justify the electricity bill. The energy management revenue just masks the failure of the mining fleet they already paid for.
I don't think it just masks it. I think it's an intelligent pivot that gives them options and stability where there was none before. It shows management can find creative solutions. And speaking of management, we should probably address the governance red flags you brought up, because they do factor into the long-term risk.
Governance red flags that require a huge discount on the valuation. You have the CEO, Rahul Muawalla, whose corporate past includes that high-stakes litigation, Muawalla versus Middleman. And while he won a jury verdict for over $8 million on claims of false promise and breach of contract, that whole trial took up a ton of executive bandwidth and focus during 2024 and 2025. I mean, that's a critical time when MIGI was navigating this really tough market and the reverse split.
But you could also see the legal victory as a vindication of his position, which should be important for investor confidence in their leadership.
Sure, but the distraction during a solvency crisis is the real issue. And on top of that, there was testimony referenced in court documents that questioned whether his employment background was fabricated or exaggerated. You combine that with the financial burden of his pay, his $750,000 base salary. When a company has only $2.28 million in cash, that salary eats up about a third of their entire cash runway every single year, just for the CEO. That is an enormous drain on a microcap that's fighting for its life.
That comparison is stark, I'll grant you. But I would argue a salary like that, while high, is what you need to pay for the kind of high-risk, aggressive leadership it takes to pull off a turnaround in a situation this dire. And what's more, the compensation is heavily weighted towards equity options, with strike prices from $4 all the way up to $20. That aggressive vesting schedule incentivizes the CEO to do exactly what we're talking about, make high-risk, high-reward pivots that are designed to hit those price targets and survive. His personal financial interest is perfectly aligned with generating the kind of vertical price move that would trigger the squeeze you're so worried about.
His incentive is aligned with generating a temporary price spike that lets him vest his shares and then lets the company raise cash through dilution. That isn't long-term shareholder alignment. It's alignment with temporary liquidity events. It's a perverse incentive. And the biggest pivot he's trying to sell the market on now is this whole AI story.
The AI pivot is a critical piece of this. I mean, it's a component of the market's potential willingness to re-rate this company. Miners with HPC capability are trading at a huge premium right now.
I'm sorry, but I just don't buy that the AI pivot is anything more than a narrative tool. It's designed to attract meme stock liquidity, period. They announced a 20-megawatt pilot co-location deal. That is minuscule in the HPC world. More importantly, they just don't have the capital to actually execute this at scale.
Why do you say that?
Because the CapEx is brutal. To build or convert to a real Tier 3 data center for AI training, which needs massive cooling and power redundancy, you need somewhere between $5 and $10 million per megawatt. MIGI has $2.3 million in cash, total. Even on the low end, they'd need $100 million just to build out that 20 megawatts. They are orders of magnitude away from having the money to do this.
Okay, I accept the CapEx gap is massive. They're not CoreWeave, they're not TeraWulf signing 70-megawatt deals. But the market isn't looking for a finished product here. It's looking for the potential to pivot. That 20-megawatt deal is a necessary first step that signals a change in how you classify the asset. It lets the market re-rate their power and land as high-value data center infrastructure instead of just low-margin Bitcoin hosting.
It's a credible narrative, I'll give you that. But narratives don't fund a $100 million build-out. The market's appetite for HPC is only going to be satisfied if the company can show a path to funding that. And with their 0.35 current ratio, their only credible path to capital is more dilution or a major debt restructuring. Both of those are catastrophic for equity holders.
But attracting that capital is precisely the point. The market is paying a premium for that credible narrative. The squeeze mechanics could act as a bridge. If the short squeeze drives the stock price high enough, it creates a window where they can raise enough capital, not just with the ATM, but with a bigger, more favorable deal, and fundamentally change the balance sheet before that short covering pressure is gone.
That's a very speculative sequence of events. It requires multiple things to go right very quickly in a high-stress environment. It assumes a perfect storm where technicals just steamroll critical insolvency.
That perfect storm is exactly what the microfloat and the 200% cost to borrow are designed to deliver. So I'll go back to my main point. The unique market mechanics here, a 1.14 million share float, 31% short interest, and a cost to borrow over 137%, make MIGI a pure trading vehicle. Technical forces are in charge of the short-term price, and for a pure speculator, the potential upside is explosive and immediate, regardless of the operational problems underneath.
And I'll reiterate that while the upside could be explosive, the certainty of capital destruction is absolute for anyone who tries to turn this trade into an investment. The fundamental insolvency risk, that 0.35 current ratio, $25 million in net debt, combined with the failure of the core mining business, it all guarantees that any technical rally will be structurally capped. Management will use any buying to service debt and fund their deficits, which ensures the stock price is just perpetually held down by the need for cash.
So what we're left with is a situation that really exemplifies the ultimate conflict in the market. I mean, the case of MIGI is where the pure mechanics, the undeniable technical pressure of a short squeeze, clashes head-on with the cold, hard reality of corporate solvency.
And which force wins, and over what time frame, that defines whether this is a massive win for short-term traders or a catastrophic loss for anyone caught holding the bag when the dilution really kicks in. It's a battlefield for speculation. It's not a vehicle for sound investment.
If you enjoyed this video, subscribe to the Stock Market Palantir channel for more stock reviews like this. Thanks for watching, and see you next video.